first quarter of 2019 saw a welcome rebound in markets following sharp falls at the end of the last year. Just as the prior market rout was triggered by the US Federal Reserve's tightening, the recovery was inspired by an about turn by the Fed, with an unexpected and sharp shift to monetary easing. As a direct result, January saw positive returns across almost all asset classes, and by the end of the quarter, the MSCI World Index had gained 12.5% in US dollar terms. Fixed income markets also delivered positive returns, particularly higher risk areas such as high yield credit. As notable as the upward moves in equities were, the sharp falls in bond yields were equally significant. The yield on 10-year US Treasuries fell by nearly 30 basis points, taking them down to 2.4%, nearly a full percent lower than the high recently reached in November. Against this supportive market backdrop, the Harmony portfolios all posted gains of between 3.9 to 10.5% in base currency terms. The US dollar growth and US dollar balance funds performed particularly well, with gains of 10.5 and 7.9% respectively, thus capturing most of the upside in the US equity market. This was largely driven by outperformance from our underlying managers, led by Granahan, whose small cap growth strategy returned over 30%. At the other end of the scale, the sterling growth and sterling balance funds delivered smaller gains of 5.3 and 3.9% respectively, reflecting weaker returns for the UK equity market and particularly from our value-oriented managers in that area, as well as the appreciation in sterling relative to most other currencies. Our recent tactical asset allocation decisions over the past year have benefited performance. Having entered 2018 carrying the lowest levels of risks that we had held for several years, we were able to protect on the downside and then increase risk levels towards the end of last year as market valuations improved, particularly through adding to equity positions. This proved highly accretive to performance, with developed markets having now rallied by around 20% from their nadir in late December. Subsequently, with valuation levels having now increased meaningfully, we decided to take some profits from these positions during March by reducing equity allocations slightly, by between 1 to 3%. On the 16th of January, we launched a new cautious income fund, representing the 9th strategy within the Harmony portfolios range. Like the other portfolios, the cautious income fund is a multi-asset, multi-manager UCITS fund, but is designed specifically to be a lower risk strategy that will provide a stable income over the medium to long term as a core holding for investors. The fund is highly diversified across multiple asset classes, and compared to other risk profiles, there is a lower allocation to equities and higher allocations to fixed income and listed property and infrastructure, areas which generally offer higher yields and lower return volatility. Portfolio construction is unconstrained, such that the fund can be invested wherever the best opportunities lie, with no persistent country or regional biases, but any resulting currency risk is majority hedged back to the base currency. Notably, this is the first fund within the Harmony range to offer distributing share classes. The objective is to deliver a stable level of income of 3 to 4% per annum through quarterly distributions, whilst at least maintaining the capital value. So far, returns since launch have been ahead of expectations, with the US dollar class gaining 4% by the end of the quarter. We also announced the first quarterly distributions, which equate to an annualized yield of 3.8% and will be paid out on the 10th of April. The fund is available through various currency hedge share classes, denominated in dollars, sterling or euros. Distributing share classes will pay quarterly distributions, whilst accumulating share classes will effectively reinvest the income received from underlying investments, resulting in higher NAVs for those classes. Investors are right to be worried about trade wars, Brexit, and most importantly, slowing global growth. However, with no sign of inflation on the horizon, central banks have considerable leeway, which allows them to keep policy relatively loose and reduces the fear of policy errors. The big shifts in monetary policy recently and sharp falls in longer-term interest rates provide strong support for valuations of risk assets. The policy backdrop will likely remain supportive throughout this year, and we expect some of the major areas of uncertainty which have held back confidence and investment, notably US-China trade wars and possibly even Brexit, to begin to lift. We therefore expect further progress in markets during 2019. However, we also recognise the risks of an unfavourable outcome to some of these events, as well as the longer-term problem of excess debt in many countries, which contain the seeds of a more serious economic slowdown. These uncertainties are enough to keep investors nervous and to trigger bouts of volatility, especially following the sharp rise in markets this year. Some period of consolidation is therefore quite likely, but we view the medium-term outlook as broadly positive and would use periods of weakness to accumulate risk assets. But market moves in the past year have once again illustrated the benefits of true diversification, which will remain vital in the year ahead to withstand the inevitable bumps on the way through this extraordinary cycle. Our investment team continues to focus on building resilient portfolios with a wide variety of underlying return drivers, with equities at the core, supplemented by a wide range of diversifying asset classes such as fixed income, property, infrastructure, gold, and liquid alternatives.